Good afternoon, everybody. Welcome to our webinar today. My name is Nancy Easterbrook. I'm Executive Director of Silicon Valley Directors Exchange. We're very pleased you could be here with us today. We have a really special program around startup boards, and today's program will really be more around the foundation of what it's like to sit on a startup board. I will make a note that this is a multi-part series, so we're glad you could join us today and hope you will consider joining us for our next one or maybe even two sessions. For those of you new to our programming, we offer educational and networking programming for boards of directors. I encourage you to go to our website, svdx.org, to view our past webinars and programs. I'm really delighted to thank Santa Clara University and their Silicon Valley Executive Center for co-sponsoring our program today. And as a special treat, we'll have Heather Buffington Anderson join us for the last few minutes of today's session to talk a little bit about their programs and opportunities there. Today's session is 1 hour in length. We will be recording it, so you are welcome to view it online afterwards if you have to leave early or want to re-listen to some of the wonderful tidbits that our panelists will be sharing with us today. So it's really my pleasure to introduce our panelists and moderator for today. I will give very brief introductions because I know you all want to get to the good stuff of our session today. Matt Bloomberg is a technology entrepreneur and business builder and currently the co-founder and CEO at Bolster. Evan Epstein is a corporate governance expert and has advised founders, executives, directors, and investors in Silicon Valley and internationally, and is the founding executive director of the UC Center for Business Law, San Francisco. Brienne Ghaforafar is co-founder of Entrepreneurial, a Palo Alto tech startup in the mobile communication and artificial intelligence space. And our moderator for today, Banafsheh Akhlagi, has over 20 years of experience as founder of a civil rights nonprofit, consultant to the United Nations, regional director with Amnesty International, and a founder of International Law Practice. She is a member of the board of Federal Home Loan Bank of San Francisco, a member of the board of advisors of Demystify, and a member of the board of SVDX. So with that, I will pass the microphone over to Banafsheh, and we'll start today's session.
Thank you so much, Nancy. Hello, everyone. This is, I am Banafsheh Akhlagi, and happy to be here with all of you on this first session of what is a series, as Nancy mentioned. What we're devoting this time to are this phenomenon called entrepreneurial boards. And the three panelists that we have the benefit of being with today have a cross-section of experience regarding this specific conversation. And I really want to underscore that this is a conversation. It's very informal. So I invite our panelists to be as comfortable in the dialogue as I hope I will be. But before we kick it off, I wanted to just kind of level set and ask a question of Evan, because we have a variety of audience members, right, who are listening in today, and they're at different stages of their understanding with respect to what are these startup, private company, venture-backed boards. What are they? What are the differences as it relates to these terms, if any?
Well, first of all, thank you very much. It's a pleasure to be here and talking with all of you about startup boards. Typically, people, when they talk about corporate governance, they go back to the public corporation and they think of large corporations like Coca-Cola or others, which have a very defined structure in the sense that if you have dispersed shareholders, you tend to have a board that is with a lot of independent directors. In fact, if you look at the Fortune 500, most of those boards, 85% of those boards are independent director plus the CEO. And so the governance is really structured around thinking how to make sure that the management team led by the CEO is taking the right decision and is not hurting in any way the shareholders, right? So that's a very classic scenario that's called a Burley-Means structure. It's an academic view of the agency cost and how you can monitor the CEO, because the monitor is the person that has the power to make decisions. And in that scenario, you've separated the ownership from the control, right? So all of this to say that in startup, that's not the case. In startups, basically you have the founders, then you have independent directors. So the typical board of a startup will have 1 or 2 founders. Then as you raise more capital in stages, a venture investor may come in. And then maybe as well, independent directors typically come in later when companies are thinking of going public. Now, there are different viewpoints of when independent directors should come in. Some argue that they should come in much earlier in the process. And so the major distinction is between private small companies and larger public companies. And that's to level set the discussion. And I would say that the startup governance side of things has not been studied as much as the public governance side.
That's very good, because I actually have a question on that later in our conversation. But perfect. Thank you for that. Let me turn it over to Matt, if I can. And if you can go a little bit deeper on that corporate board, private board distinction. And what would you say specifically are the significant differences when we're looking at private companies and their various stages, right? Whether they're in a Series A versus a C or a D round, what are we looking at in terms of these distinctions?
Yeah, well, Evan is exactly right. Private boards and whether they're venture backed or sort of founder owned, bootstrapped, are notoriously insular. And I think the issue driving that is generally if it's founders, it's one around control or fear. And if it's a mix of founders and VCs, it tends to be more a lack of attention to the board and the good things that can come from having independent directors and like a little bit richer governance model, where they just feel like it's not a priority for their business, I would say. So one would like to think that there is a pattern between maturity of company and number of independent directors, and there is, but it's just not as strong as you would like. The research that we've done at Bolster indicates that the vast majority of private boards don't have any independent directors at all, and while that's a little less true for a Series B, C, or D company, it's still pretty true. So in the research that we've done, like a third of Series C and D companies still don't have any independent directors. And so those boards are just VCs and founders. When you look at the really early stage boards, seed stage, Series A, 2/3 to 3/4 of them don't have an independent director. 80% probably don't have an independent director. So that's sort of the landscape. There are plenty of boards that do, and that do have multiple independent directors. We certainly evangelize that because, just as a CEO, the best board conversations are the ones that have diversity, and I don't demographic diversity, but also diversity of thought, diversity of experience. And if all you have around the table are VCs and founders, you just don't get that.
Let me add one little thing to what we just said. It's also very important, depending on the ownership structure of the company. So there may be startups, there may be family businesses, there may be nonprofits, there may be state-owned enterprises have a different governance model. So when we talk about startup boards, it's a private corporation that is not public, right? This is distinguished, for example, from a partnership or an LLC. So I think it's important to say that, because people tend to think that governance applies to all of them, but each organizational structure has its own governance principles.
Very good. Very good. Thank you for that addition. Brianne, let's look at it from your vantage point as a founder of a startup. So at Entrepreneurial, when did you decide with your executive team that it was time to form a board? At what stage were you?
This is a great question. For us, it happens at a point of growth, right? It's really about putting objectives to practice and making sure that we're fulfilling very specific company needs. Those needs can vary depending on what the company is, what the growth phase is. For us, we were very specific in our search for board members and very selective in that search. And for us, investment is actually a criteria for someone to join Entrepreneuril's board for the purpose of making sure there's vested interest in the company's success. So capital milestones, team milestones, customer milestones, right? Bringing in new groups of people and new networks. So we're very practical in the way that we do that search. And it also really creates the criteria for who you'd be looking for, whether you'd bring in a former CEO or a current CEO or a CFO, right? Or somebody else that has a certain level of experience. And I think as we grow, our needs are also changing as a company. There are certain times where, you know, growing capital and bringing in certain connections is super important. At other times, you know, just getting guidance and being able to go from 0 to 1 is really important. Some startups, I would say, they have investor requirements for board seats connected to funding rounds, where, you know, they make an investment and you're required to give them a board seat. In Entrepreneuril's case, we've always been in a pretty strong position where it's been voluntary on our part as a way to accelerate our growth. So we are fortunate, I would say, to have been in that position and to have had the opportunity to be very selective about who we bring on board, and then who we can train in that function, and then how we can grow as a collective group.
Very good. Very good. Thank you all for really setting that first preliminary foundation. So now let's kind of take it to the next stage. And I'll start with you, Matt, if I can. You know, if a potential candidate comes to your organization and says, listen, I'm doing this search for a private board, how do you advise them on what ways in which they want to position themselves? What do you want, you know, to have in terms of background? You talked about diversity of background and experience set. How do you advise someone who's interested in a private board?
So I think there are a few things that are important. One is CEOs want to put people on their board who are sort of great corporate athletes. So, you know, just because you have, you know, been a senior executive doesn't mean you're versatile, doesn't necessarily mean you're a great listener, a great communicator, or, you know, sort of able to articulate points crisply. Doesn't mean you have good range. You know, you could have been a wonderful head of sales, but you can't read a P&L. So good corporate athlete is sort of, you know, sort of number one. I think the second thing is you want someone who's board ready. So you as a candidate want to explain, if you've been on a corporate board, fine. If you haven't been on a corporate board, what are things that you can demonstrate that say that you're ready to be on your first corporate board? You've been on a nonprofit board, you've been on the board of you know, a community organization, you've been a senior executive reporting to a CEO, so you've been in board meetings, you've reported out to boards, you've had boards grill you, you've taken some you know, board training courses, whatever those things are, you need to be able to articulate. But then in terms of, you know, so I would say those are kind of the table stakes items. In terms of positioning yourself, and the most important thing is to position yourself accurately and authentically. I think we're all a little bit jaded by George Santos at the moment, but you know, I think the things that CEOs tend to look for, and the framework that we take our clients through, and the framework I use when I'm hiring a board member, is really about 4 things. And every candidate has these 4 things. You just have to have a really good narrative around your version of the 4 things. So the first one is your functional area. Are you a CEO, a CMO? You've been a product person, but you've also been a marketing person. So what functional lanes are you, do you have expertise in? The second is your industry or industries. So where do you have contacts? Where do you understand the ecosystem? The third is some combination of sort of customer set and business model. So you're familiar with subscription models, or you're familiar with hardware software combination businesses, or you're an SMB person. All the companies you've worked in have sold into small businesses. What, you know, sort of what's the business model or customer set you're most comfortable with? And then the final thing is sort of stage and stage transition. Have you operated big companies? Have you operated small companies? Have you operated companies that went from small to medium, that went from large to public? sort of what area of expertise have you worked in terms of level? I think if you can really cleanly articulate those 4 things, and you're a great corporate athlete that's board ready, it's not going to guarantee you a board seat, but that's the information that most clients are looking for when they're thinking about who to put on their board. I'm curious for Brienne's take on that.
Actually, I was going to
Brienne as well. So.
You're reading my mind map. Yeah.
Well,
So how is that for you all at Entrepreneurial? Are you searching for a particular candidate at a particular time in that growth stage, as you were mentioning? And if you could kind of walk us through some of your selection criteria and structure.
I love it. Well, I just want to start by saying, Matt, the corporate athlete is so spot on. It's so on point because just getting the endurance, right? Businesses are always evolving, right? Every business has ups and downs, and being able to constantly drive forward and create growth and be able to bring your skill set in to drive value is so critical. Boards are not passive, right? It's not passive enrollment. It's a very active engagement. So occasionally, we've interviewed many people for those positions. We've looked at tons of candidates. We have a great, opportunity of meeting so many people in our line of business. And as an AI software company, the reality is, who wouldn't want to put AI software company on their resume as a board member, right? It's something you just kind of have to have in your repertoire of your portfolio. So for us, we have to kind of vet those criteria out in the process. And I think Matt brought it together really nicely. It's really important for us to know when we're going through that process and we're interviewing people, there's a courting period, right? After someone has invested in your company, you get to know them a little bit better. You get to watch how they're providing advice, what kind of referrals they're bringing in, what kind of initiatives they have in mind, whether they're totally on board and supportive of the company's vision, and whether they have the skills and the network to drive the company forward. There are a lot of people, we like to say that it takes a community to nurture a startup, right? To grow a business, and it truly does. But there's, 5-10 people that are at the forefront all the time that are driving that value. And to be able to vet that community is really, really critical as a company is moving from stage 1 to stage 2 to stage 3 and every step of the growth afterward. So we like to find out, what is the superpower they're bringing to the table? And Matt brought that up as well, right? What's that special skill set? Is that something we already have, or is it something we need to augment with another individual? What are the best and worst experiences they've had on boards previously? That kind of tells us what they've had to deal with and what they're going to be prepared for. How much time, capital, or resources can they dedicate, or can they refer or bring into the network? These are all really critical factors, I would say, when you're looking at board candidates. And one of the biggest ones that I think, it's maybe a little bit undervalued and maybe nobody talks about it until later, but it's the chemistry fit. Getting to really understand the people that you're working with on the board, really know them, what makes them tick, and whether or not your visions are aligned personally and professionally. I think it's critical. Board positions are very intimate, and there are differences between advisory functions and pure investment functions and your board of directors. And that's a serious seat.
I want to spend some time there on culture fit. You termed it chemistry fit. This is, I think, an area that most people potentially take for granted. They think that, oh, well, we're going to have the same kind of background, and that we know one another. We've socialized, or we worked together in the past, so we're going to be able to sit around this table and be able to now work on these interesting issues. I have noticed from my experience that's not necessarily the case. Those seamless conversations that might have happened in another setting may become very conflict-driven in this setting. And so what would you, and this is really a question for all three of you, how important is culture to the mission, the ultimate goal of why we're all here? And how do you go about really finding that fit? Because people interview well, those resumes and board resumes and CVs look amazing. And
Yeah.
you're only going to be talking to people that on their references that, you know, are championing them. How do you vet for culture and how important is it? Let me start with Evan.
Well, let me be a little bit controversial, just to add into the discussion here. But imagine you're in a venture-backed company where it's controlled by the venture capitalists or the investors. Maybe you have a very strong founder. It's not easy to let control, right? And sometimes the fact is, do they really want an independent director with them? Are they really going to listen to them? And sometimes that's not the case, right? We have many cases where you have a very strong founder who really wants to call all the shots. And so I always say that the board has a lot of importance, particularly the chairman of the board, the person who is leading that board. And it's very hard to get that chemistry and get that group dynamic, that respect, because let's be honest, if you have a company that's $100 million of venture investments, and then you invite a director, he doesn't or she doesn't have the same weight in that room, right? He doesn't have or she doesn't have the same financial backing of the company, stakes in the company. And so there is an imbalance, and it really depends on all the people. It's not only the independent directors, but it depends on the founders. It depends on the investors. So remember, if you have a bad investor, that's probably the worst thing that you can have. It can kill a company, right? And so this is why it's so important. Every seat is very relevant, and the role of the chairman or the lead independent director in leading that culture is critical, in my opinion, because otherwise you're going to have maybe one portion or one viewpoint that is going to be pushed upon the others. And the last thing I'll say is there are two types of bad boards, right? The rubber stamping board, the one that they do everything that the CEO says, or you have the other type of board where you have the overbearing board, where you have directors who think they know more than the CEO and try to do everything, in their behalf. So that balance is very hard to achieve, and it's one of the critical points of governance.
Brianne, how about you? How do you guys?
No, I love what Evan said, and when he says controversial, I'm thinking I agree on many fronts, because to me, culture, it's not necessarily the same as agreement, right? It's not the same at all. In the case of Entrepreneurial, at least, right? Culture fit is, of course, being aligned on the vision, but it's all about how you go about your collaboration, your analysis, your strategy for the business, right? Being aligned on the common goal, which is to grow the company and to grow the value for all stakeholders. I'll go so far to say stakeholders, not shareholders specifically, right? But everybody involved. For Entrepreneurial is all about creating enduring value. And even those controversies, they can't be avoided, right? You always are going to have a discussion is healthy, I should say, right? So it's all about making sure that chemistry fit is very aligned. And the best ways to see what that's like in action is, speaking on the phone. It's engaging in discussions, meeting at, your office, going to lunch and tea and coffee, and taking some of these conversations seriously and being proactive about that to make sure that your chemistry fit is aligned before you're formally engaging in a board relationship, right? Because if that dynamic is there and if it's positive, then you're on a pretty good track. But if there's so much friction and you can't get through some of those discussions cleanly or properly, then it could cause some problems in the formal position as well.
Very good, very good. And really, that chemistry fit goes both ways, correct? It's the candidate who's looking at the company that they're going to be spending valuable time at, and there's also obviously the company looking at the candidate. So from the candidate's perspective, what would you say, Matt? What are some of the key things that they should be asking and looking for?
Yeah, let me kind of build on the last answer and your question together. So I think in terms of assessing fit, which is absolutely two ways, you can only get so much out of an interview process. The deeper the interview process, the better. And that's not just, you as a CEO screening a bunch of candidates. It's when you find the one you like or a couple that you like, You have to interview them. You have to have people on your team interview them. You have to have everyone on your board interview them. You need to do a deep in-person interview. And I said this to people during COVID. I did it during COVID. I was like driving and seeing people outside in the freezing cold, because there is just no substitute for sitting with someone for a few hours and seeing their body language and sharing a meal and really going deep. But the biggest add that I can throw into this part of the topic is we always do, and we always recommend that clients do basically an audition of someone for a board seat. And what we mean by that is have your finalist attend a board meeting before you put them on the board. And assuming it goes well, then that was their first board meeting and you date the options before it. But that audition gives both sides of the equation, the candidate and the board, an opportunity to assess fit in the wild. And it's not perfect either, because it's not the second, third, and fourth, and fifth board meeting, but it's better than the interview process. So you have to be prepared as a candidate to invest real time in that. You haven't been put on the board yet. You have to attend a board meeting. You might have to travel for it, and you have to get ready for it. The CEO also has to invest time in it. The CEO has to not just send you the board book, but has to walk through it with you and coach you on the board meeting, because you don't know the dynamics of the room and you don't know the acronyms of the business and all the details the way everyone else does. So it is a real investment of time at the end of a process. But I have bounced 2 people out of a process when I was sure I was going to put them on the board after an interview. And one of them was mutual. The person that like clearly felt like he didn't fit with the board, and we felt like he didn't fit with us. And it was really interesting. It wasn't sort of an issue of like we were a rubber stamp board or a micromanaging board and he wasn't the right type. It's that my board, and this is my previous company, Return Path, my board had a lot of really big personalities on it. So from the venture space, I had Fred Wilson on my board, I had Brad Feld on my board, I had Greg Sands on my board, I had 2 other independent directors that were also, just big personalities. So our board meetings were very animated. We were really like good at productive conflict. Like we're kind of in each other's face. And it was an amazing board. So I told this prospective board member this. I said, you got to come ready to talk. I walked through the board book with them. I said, these are 3 areas where I think you could really make a contribution to the conversation. I said, it's super important to me that I have someone on this board that can go toe to toe with Fred or toe to toe with whoever. And the person proceeded to sit in the board meeting and not say a word. And even when called on, like, hey, so-and-so, what about your experience from such and such a company around this? 2-word answer. It was like talking to my 15-year-old son. So, that was when at the end of the meeting, he left the room so we could talk about him, and we all looked at each other and we said, well, what are we adding to the board? And I went out to talk to him and he said, wow, that was really uncomfortable. I don't think I could sit through this. So I think you learn a lot from that audition. I realize I've been talking for a while, but can I add sort of one other thing, which is,
Please.
I think fostering culture on the other end of putting someone on the board is as important as vetting for culture up front. And the best boards are the ones that have a social dynamic, where the CEO treats it as a team and is responsive to team dynamics and pays attention to team dynamics, where you're having dinners a couple times a year, even now that people aren't traveling as much for board meetings. And where the board, just like a good executive team, the board gets to know each other as humans. They get to see each other's vulnerabilities. They get to know about each other's family life a little bit. And all of that helps build good culture on your board.
It's really, really important, both from the private side, right? Creating that humanity and that connection. But also, I really enjoyed what you said about the auditioning, bringing them in, have them get a taste of what the different individuals on that team and how they interact. I think it's essential. So let me, Evan, go to your background. I know that you are involved on the litigation front in this space. And what would you share out to our participants as they are going forward on this pathway? What are some I call them landmines. But, what are some of the things that they want to be aware of? What questions do they want to be asking? And really, if you can talk a little bit about their own personal liability and risk exposures, because I think that's an element that board members overlook. So if you could kind of give us a little understanding, and I've actually seen a few questions that are coming in from the participants. They too are eager to know about how to navigate.
The lovely topic of litigation and disruption in terms of boards. Let me say, let me give you an example. And this is the classic example in startup boards, right? Imagine they start a company, 2 or 3 founders, they raise money, they are growing, they raise at an up round in Series A, they raise an up round in Series B. And suddenly in Series C, things are not going that well, right? And by the way, this is very relevant for the times in which we're living in, right? Growth is not there. There's a lot of companies currently in that position where either you don't have any money left, or you may have to do a down round, which means you raise money at a lower valuation than the previous round. Well, in that case, it becomes very important what the board does, because in these classic boards, there are a lot of conflicts. The investors that already invested may want to invest and have some protections. They have some anti-dilution protections, and maybe the effect on the dilution is different for them and not to the common. You can have wiped out common shareholders, meaning the founders or the employees. And so these decisions become very important because it implicates your fiduciary duties. And here is where independent directors are really important, because they can be called upon to make independent decisions that the investors cannot make because they already have some contractual protections built in. And people don't understand that their fiduciary duty is actually to the common shareholder and not the preferred shareholder. So I would say that is a classic scenario. This is what we call the preferred versus a common scenario, where you have a dispute among different classes of shareholders. Now, there are a lot of different types of disputes. There are founder versus founder, which is a common versus common. You have different investors, preferred versus preferred. So I think that the important lesson here is, when a company is doing well and growing, everybody tends to be happy. The employees are happy, the investors are happy, the independent directors are happy, and it's great. But it's really when you have situations where you have down rounds, when you have maybe the company not doing that well, that you really have to think about, okay, now we're going to roll up our sleeves, we're going to think about what we're doing. And it's typically in a case where you have to do a down round, where you have to do a recap. If you sell the company, right, at what price and when and how? Because the founders may want to keep going, right? But the investors may want to cut their losses and say, well, if we sell at this price, maybe we do 1x, 2x, and we just move into the next one. But the founders, it's their livelihood, right? So you may have diverging interests there. So I would say that you have, as an independent director, if you're not an investor, not a founder, and if you're invited to a board, you really have to understand what is the business of the company. You have to bring something to the table, and you've got to take your responsibility very highly, because if it goes to litigation, be very strong, right? And so that's kind of my 2 cents in terms of, and by the way, people look their responsibilities here, and they tend to get into problems at that stage. And I've seen a lot of cases where they didn't look at a term sheet. They made a decision in 1 or 2 days. They kind of were rubber stamped because the VCs pushed this deal. And I think that's a bad position to be in.
So, Brianne, your perspective on this. Let me ask you this way. I know that you are very clear with the potential candidate. These are our asks. These are our standards for you taking this seat. and maybe you can articulate what some of those are, but what would you want the potential candidate to ask you? What are they not asking? And then they come sit on the board and they're surprised.
No, I mean, that's a great question. I think generally they need to understand what the company needs are so that they can know if they can fulfill them, right? Or if they can support the needs through the extension of a network, right? Or a skill or advice that they may have. So understanding what the company needs and whether or not that gap can be solved by bringing them into that roundtable, I think is very important. Understanding what the company is going to expect from a time commitment standpoint, or of course, from an investment standpoint in our case, right? And that needs to be kind of clear up front. Most people are used to getting paid to be on boards, right? They're not as much used to investing to be on boards, right? In that sense, as a prerequisite to the invitation. So there are a couple of things that are really important for them to ask so that the expectation is aligned. And I think what Evan mentioned is pretty important too, because you want to make sure that the person coming in is pretty aware of what their duty is. And it's, more to a group than to their specific investment, right? As an individual. So depending on what the circumstances may be. So that's pretty critical as well. And the other piece I just wanted to mention, and I didn't get a chance to share it earlier, but I wanted to mention as a global statement that being able to provide references from prior seats you've sat on or other entrepreneurs you've worked with is also helpful in those discussions. Generally, going through referrals can be that point of reference, right? So in our case, we do a lot of our hiring and a lot of our board development through referrals, and that creates an added layer of not only trust, but reference check, right? And if you're going through, a search agency or something like that, you can just as easily request references as well, because that points to any prior experiences that that person has had. So if you're a board candidate coming in, offering some of those things up front is very helpful, because again, this is a highly trusted position from a company standpoint. And also understanding the needs for confidentiality and privacy and the importance of not having conflicts in portfolio companies. These are all really important things for the company that a potential board member would need to understand when they're coming into that table. So again, some of the questions that they should be asking, clarifications that hopefully they would be making, because it's much easier to hire a board member or even to join a board than it is to be removed from a board, just from a process perspective. So those are just some things that come to mind initially.
You just touched on the next series of questions that I have, but let me put a pin in that for just a minute and go to Matt. You beautifully outline 4 things you should ask on this, 5 things you should know about that. And we're going to talk about your book at a little bit later. But what would you say to a potential candidate? What do they want to know? What are those risks that they need to become comfortable with, to be aware of? And as they're having those discussions with the founder, right? As they're having those discussions with other members of the board, potentially, or others in the industry, what are those key questions?
Startups are easy. There's only so much to know about them. We certainly would want a candidate to understand the company's financial position. And that is, it's going to be different metrics to look at for different types of businesses, but at a bare minimum, it's like cash burn and runway and sustainability of revenue, and when the likely next financing is. Doing a lot of financial diligence beyond that isn't useful, but it is useful for a candidate when they're interviewing with VCs, for example, if it's a board that's past the seed stage, to get their perspective on it, to understand how their firm views the investment, what their plans are for doing follow-on investments, do they ever lead inside rounds and things like that. So sort of shareholder diligence in addition to basic financial. Legal diligence, definitely worth asking some questions. But other than like, are you in a lawsuit? It's a little hard to diligence. Like, could you be in a lawsuit? Or there are a bunch of things like that. You certainly, as a as a prospective independent director should understand that the company has appropriate D&O insurance, which you'd never ask at a public company because they have to. Private companies, if they have venture guys or venture women on the board, they have D&O. But if they don't yet, it's worth asking that question, and it's worth making them get it for sure. It's a little different than joining a company as an executive, but it's not all that different.
Let me add something there because it may be very legal in nature, but even if the company has D&O insurance and you are sued for a breach of a duty of loyalty, which is a conflict of interest, then your D&O doesn't cover. And so it's a very, D&O may cover only, and you have indemnity clauses that cover maybe duty of care, but this is important to know as well. And it's a very bad spot for an independent director because the VC will have D&O and will be protected by their own firm as well. So, of course, that's more in the weeds. And the reality is 95% of all companies are not going to have any litigation. It's very rare to see litigation in startups, right? So we're talking about a very narrow set of questions that by large don't happen, but you still have to be aware, right? Like you don't want to be in that 5% of cases that you are dragged into court and you have these problems. And typically the reality is most companies have bad governance or badly run. I mean, let's be honest, in Silicon Valley, most of the board are controlled and you don't have independent directors and people are not really thinking about governance. People are thinking about growth, about, the business side of things. It's only when companies are public and later stage that really they put a lot more, intention in how to structure things and do things the right way. And that comes with a trade-off, right? So it's exciting in some ways, but you should do the minimum, right? You should know who you're dealing with, what's the type of situation, who are the type of investors, what's the founder. I mean, you take a newspaper today and you read any story about fraud, I mean, left, right, and center. There's these people doing tender offers now where they are taking the price at a higher price and letting the rest take a much lower price, which is a complete breach, right? And so how much of the shenanigans are happening? I hope that if you're an independent director, you're invited to board, you should be aware of that stuff.
Yeah. So look, let me build on that with a horror story. So I joined a company at some point in my career as CEO. It was an existing company that was hiring in someone from the outside, and you will not find this if you look at my profile online anywhere. It has been expunged. And so I was, board member and CEO, and I got there and started discovering some pretty significant ethical problems. Not fraud, not legal, not financial, but stuff that made you feel like you needed to go take a shower. And really hard to find some of that stuff out ahead of time. Like there was no documentation anywhere of anything. It's not like the company had, I don't know. Sometimes it's not possible to get to the bottom of everything. And it's certainly not possible to get to the bottom of future problems, right? Founder conflicts is a great example, Evan, that you brought up, that you can figure out if there is a conflict or if there's been a conflict, but you can't necessarily figure out if there's going to be a conflict. There's only so much you can do. You got to do the best job you can once you're on the other side and you're on the board. And if you get to a place where there's some kind of intractable problem, then you think about leaving. Like you're not obligated. It's different than being an employee, an executive, where you feel like, oh, there's like a black mark on my resume, I job hopped. If you're on a board and there's stuff you don't like that's going on and there's nothing that you can do about it, or you can't influence the board enough about it, you don't have to be there.
Well, let me give the example maybe, and I'll just put this little example and then let Brienne kind of fill in here. But Theranos, famously, now that we all know the story, had an independent director that early on was asking all the questions. And, this is all in the record, and Elizabeth Holmes would not give him the information. And then the chair of the board sided with Elizabeth Holmes, and he realized, look, this company is not for me, and he resigned. And so that's sort of a story where, we all have heard how bad that board was, right? Like they didn't do anything, no oversight, $9 billion of valuation at some point, but at least it was somebody, right? And it shows you that doing your work as a director is really important. And if you see these things like what Matt is saying, you probably should resign, right? And it just makes it very hard to know what's going on in these companies as well, because it's private companies, there's no public information, and a lot of these things are very hard to uncover.
Yeah, I agree. And a lot of it is things that you also learn, right, as you're working with the people on the board. But I agree with what you guys are saying. It does make sense. And Matt, your story is crazy. It's too bad.
Sometime with about 100 people listening.
Well, let me step off of what we're talking about and go into something more timely. The conversation of today in terms of time commitment, what are my roles and my responsibilities on the board? These are real. And what we're finding is that potentially in the years that there were, they were the golden years of 2019, 2020, 2021, potentially 2022, coming into 2022, we started to find many individuals who were doing this thing, this concept of overboarding that is now being discussed in write-ups. And overboarding, for some of those who are listening today, is basically finding yourself accumulating a number of board memberships, right? You're sitting on a number of boards. And what used to be the trend of maybe about 5 or so boards, today you can see a board member on upwards of 17 boards at a time. So
VCs, not independent.
VCs, yes, venture backed. And so when we're talking about looking at selecting, requiring, needing these board members and their expertise, their potential Rolodex, their conscious commitment to your company, what do you think about this overboarding phenomenon?
So let me take this one just because maybe there is some legal implications here.
Please.
So number one, a director a VC actually has a nomination right. So it's his money, so he can pick where he sits on the board. Very different to an independent director. So essentially, it's a function of how much money they are deploying and they decide to invest in. And so, yes, it's very common for VCs to be in many boards. Very different to be talking about directors overboarding in public companies, because the trend, or at least the good practice, is that now you shouldn't be in more than 3 public boards, right? And if you're the CEO of a public company, you should be maybe in 1 other board. So it's true that the practice of overboarding by venture capitalists in private companies is very, very different and very separate to overboarding in public companies by independent directors, because everyone is an independent director in a public company other than the CEO, right? Mm-hmm. So the question then becomes, well, is overboarding in VC bad because before there were 6 companies and now they're in 10, 12, 13, 14? Well, you can imagine that if you are making a lot of investments, your time is limited. So basically, that is what you are dividing your time in different boards. And it's true that if you're sitting in 17 boards, the reality is how much attention and thought and value are you adding in those 17 boards? Some VCs, and I think Matt can talk about this, have decided not to take their seats, but take observer seats. So they're not fiduciaries, they're not full board, but they have observer seats. It's another way to do it. And maybe, that has different issues, but it's not a real board. And so I think we have to be very careful on how we think about this topic, because again, the nuance of separating practices in industries, in stages, in geographies is very important. And we shouldn't confluence the idea of overboarding in private venture-backed companies with public companies, because those parameters may be set by ISS or Glass Lewis or the large institutional investors, has a very different origin and concept.
Matt, what do you think of this overboarding concept?
When I first got Brad Feld on my board, who's a VC in Colorado, he was on 33 boards. I think that's a record.
Wow.
He was an amazingly effective board member for me, and most of his other boards felt the same way. Like I knew a lot of the other CEOs in the portfolio. I also had a board member once who was at a private equity firm who was on 3 boards. He was awful.
Mm.
I think Evan's right. It's a different game, private and public, and
yeah, and just to add into that, it's true. I mean, it's very context specific, right? Maybe one individual, maybe Warren Buffett, only takes 1 minute to give you a full value that no other person spending years on your board would ever give you, right? So it depends a lot on who the person, who the investor, who the board member is. And I think it's hard to make a blanket statement. Now, everybody wants to be Warren Buffett, right? It's the same question when you talk about dual class shares. This is when founders get multi-class voting structure, super voting. And, some people can do it. Again, Warren Buffett has dual class shares in Berkshire Hathaway, but then everybody thinks they are Warren Buffett or Larry Page or Sergey Brin or whoever has it, right? And that reality is not everybody kind of has earned their the capacity to be on 10 or can you imagine somebody being 33 boards and be hyper efficient? That must be a rarity of rarities.
How about you and Brianne? How do you, when you're vetting, is this one of your questions? Are you looking to see if an individual is overboarding? I guess it's kind of a pun on words, maybe play on words.
Well, apparently it's not just a board consideration now, it's a question for employees as well, right? As you're looking for new candidates, you find out they have 3 different jobs at the same time. You guys were saying that in the news, I'm sure. I think fundamentally, a board position is an active position, right? We've talked about that being an active role. It's not so passive. I mean, there's some cases where there are people that are on the board just to watch their investment, right? Or just to observe, like Evan said eloquently, the board observer, right? Is a little bit of a different function. But just generally speaking, I mean, there are exceptions to that rule, but it's better to focus on, I would think, working with fewer companies so you can invest more time, more energy, more for the growth and to achieve the objectives versus spreading yourself too thin just to fill your resume. That said, there may or may not be exceptions. I mean, Matt provided an example where there was someone who created great value for him by spreading themselves thin like that. And there could be ways to do that and create efficiency. But in our experience in the past, I mean, generally creating that focus, I think at the end of the day, it's going to come down to the person, right? We're very people-centric as a company. So everything is about finding the right people to perform various functions and finding the efficiency in the way they provide time. And sometimes it's as easy enough when there's an initiative to call up somebody or make an email introduction, and it can change so much with such little investment. So it's all about creating that efficiency and having that focus to drive value.
I'm so excited that we're actually have made this into a series for this topic, because there's so much more to cover, and we've just scratched the surface. And there are some other questions that we're going to be focused on in the next session that are more functional in terms of, how do you negotiate compensation? Is it shares? How is it that that process takes place? But what I want to do is turn the virtual microphone over to Heather in just a moment and share with all of you that Matt has placed a link that links to bolster.com and is inviting the folks here at SVDX to come, join, learn, and expand the community. Again, it's at bolster.com. And I think the link, I don't know, Nancy, can all of the participants see that link? Yes? Okay, very good. All right, I'm going to turn it over to you, Heather, and I want to thank my panelists for this rich, meaningful conversation today. I learned a lot. I'm sure our participants have as well, and I hope that it was meaningful for the three of you as well.
Very much so. Thank you for having us.
Thank you very much.
Yeah, absolutely. Thanks.
Heather, please take it away as a path and as a way in which people can start this journey onto boards, and you have a pathway, right?
Thank you so much, Banafsheh. Thank you to all of the panelists for this really rich conversation. I want to thank SVDX for the vision and the opportunity to co-sponsor this event, and also to open it up to the alumni and community of the Women's Corporate Board Readiness Program and the Black Corporate Board Readiness Program communities. I'm Heather Buffington Anderson. I'm the Program Director for DEI Initiatives at the Silicon Valley Executive Center. And today's discussion of entrepreneurial boards is one that we address in the curriculum of our WCBR and BCBR programs. For those of you who are interested in board service, these two programs that we offer within our center at Santa Clara University concentrate not only on, the nuts and bolts of being a successful director, but also expanding networks and creating connectivity, and especially focusing on the lived experience of Black corporate directors and women directors across industries. We try to address the myriad types of boards that one could consider for your board portfolio going forward. And this is a discussion that amplifies what we address in the curriculum. And we really work on that connectivity piece. Matt is great at helping us think through the courtship selection, that process of going through and finding the right board seat for you. But we also talk about the lived experience, what it means to walk into a boardroom when you are the one and only. And Banafsheh has been so lovely to come back, not only as a program alum, but then to facilitate sessions within the Women's Corporate Board Readiness Program, discussing intersectionality and how that shows up in the boardroom. And we work really carefully to pair each of our participants with mentors that come from a lived experience and expand networks. So I'll drop links for both of the programs in the chat, and as well as my email address, and you can contact me directly if you have any questions about our programs. Thank you so much to Banafsheh for this vision, and thank you, Nancy, for the opportunity to speak.
Thanks so much, Heather. And just as we wrap up, I want to say special thanks to Banafsheh and to all of our wonderful panelists for joining us today. And I will be sending out an email. I know there's a ton of links with all the wonderful, great information from Bolster. Evan's got a really great podcast series as well. And of course, the Santa Clara program. So I will send an email with all that wonderful information and hope you'll join us for the next webinar, which will be 3 weeks from today. So thank you again, everybody. Have an enjoyable rest of your day.